Futures are pointing to a stronger opening in the U.S. equity markets. Good morning, I'm Joe Doe, reporting from Wall Street on this Monday, November 4th. Futures are pointing to a higher opening as investors await a busy week of economic indicators, which kicks off with factory orders this morning. Economists were forecasting orders to gain 0.3% in August, which follows contraction in the space for the previous month. The October jobs report emerges Friday. Markets will be keeping a close watch on those numbers to see how the U.S. labor market was affected by the government shutdown. Economists are looking for 120,000 payrolls added in the month. European markets, they're gaining Monday. The FTSE in London was gaining more than 0.5%, while the DAX in Germany was lifting more than 0.3%. Here to talk to me today about the future of the eurozone is Kathy Jones. She's a fixed income strategist at Charles Schwab. Kathy, thanks for joining us.
Oh, thanks for having me.
So Kathy, we've been seeing some stronger economic numbers coming out of Europe, say like the 0.1% gain quarter over quarter in Spain, the first positive print there in 9 quarters. And we've seen softer economic data in the U.S. But do you think people are ignoring some of the softer data here because we are finally seeing some growth in Europe?
Well, it's no longer the crisis feeling that it was, a year or two ago. And I do think we're sort of sloughing off some of the softer data here, partly because of the talk about tapering and partly because we don't feel like we're in that same sort of crisis mode that we were for the last couple of years. But I would just point out that Europe, a 0.1% increase after cratering for 9 quarters is not a really robust pace of growth. Europe still has a lot of big challenges ahead, and I wouldn't count on Europe to be an engine of economic growth going forward.
Do you think, though, that because we're finally seeing some sort of uptick, that does kind of lead investors to be less worried about even a slight pullback in numbers in the U.S.?
Possibly, because the idea is that all the cylinders of global growth are moving. They may not be popping at a fast rate, but they're at least all sort of turning over. The thing that I worry about coming out of Europe is the banking sector. We're still seeing credit contract. It's really tough to get an economy to grow when credit is contracting, and it is in Europe. They're going to be introducing stress tests for the banks, which is probably going to push them to conserve more capital. And there's a real tendency towards almost deflation, certainly in the periphery, and very flat inflation overall.
Sure.
And that worries me that we're getting a little too optimistic about the contribution Europe can make to growth going forward.
Well, with that in mind, I talk to a lot of equity strategists who say, oh, look at Europe, there's a lot of possibility there to invest. More fixed income strategists like yourself that I talk to say, maybe not so much. What's your take finally?
Yeah, if you're just looking at growth, Europe would not be the place that I would be really enthusiastic about. And in the peripheral bond market, there's still a risk of restructuring in some of those countries, so we would still avoid those.
All right, well, Kathy Jones of Charles Schwab, thanks so much.
Thank you, Joe.
That's all we have for today. Reporting from the street, I'm Joe Doe.